Good day everyone, I'm Chan. Today I'm just going to explain a little bit more about my thought process on matters like gold, interest rate and yields on treasuries. I would just like to bring you guys up to speed about what's going on in the gold sector in developing countries, and I'm referring to Indonesia and China to be exact. China has recently allowed Chinese RMB savings account to be linked to bank-held gold accounts. What this means is that the average Chinese will be able to use their savings to buy and invest in gold directly. While in Indonesia, Kinesis has formed strategic long-term public-private partnerships with multiple government and national entities in Indonesia to open up Sharia-compliant physical gold as a currency for the entire population of Indonesia. Another thing that has been in my mind lately is the effect of near zero interest rate in the last 10 years in North America and Europe, which I believe has introduced a lot of new and costly regulatory inefficiencies like net zero and ESG regulations. The proliferation of useless and costly standards that doesn't actually lead to net increase in productivity is actually a result of near zero and negative interest rate in the West for close to a decade or even more. What this means is that governments were basically borrowing lots of money with huge, bigger and bigger fiscal expenditure without any significant cost in the last 10 years because of near zero or negative interest rate. But it wouldn't last moving forward because interest rate, as we know, has gone up drastically in the last 1-2 years. In the US, it's now 5% interest rate, and in Europe, it's going to go 3-4%, and it's anticipated to go up even more further. Businesses basically have to pay more to comply with new ineffective regulations, and this cost ultimately will be passed on to consumers anyway in the form of higher prices for goods and services. Now let's talk a little bit about Bitcoin. The interesting thing about Bitcoin is that Bitcoin isn't cracked down by the SEC, and Bitcoin isn't a fiat because of the exponential energy that is needed for each new Bitcoin mined. This puts a ceiling of no more than 23 million Bitcoins that could ever be mined. The fact that Blackrock, with Larry Fink advising the White House, is building huge positions in silver through PSLV or Sprott Physical Silver Trust and in Bitcoin ETF seem to indicate that US CBDC perhaps can be backed by commodity that may include Bitcoin and silver. Does this mean that Wall Street is interested in continuing to do business with BRICS through mutually agreed upon commodities-backed CBDCs to allow trade across economic blocs? Another thing that has been on my mind lately is on the perception of risk-free rate. Is sanction risk or seizures of assets like bonds inbuilt into risk-free rate, or an externality that is not considered as part of risk-free rate? Typically, when we talk about risk-free rate, we refer to the yields on treasury bills. And if recent news has indicated anything, is that treasuries, your assets in treasuries, can be seized by the US government. So if assets can be seized, is it still considered as risk-free? Just a rhetorical question. We view any assets that is issued by the US government as risk-free, but this view may not be returned to us in kind. Therefore, we must be able to correctly read and quantify a subjective view of that counterparty, which is the US government. What are their views of us? If they view us as a non-zero chance for asset seizure, good luck to our definition of what it means to be risk-free. Based on the statistics of asset seizures and sanctions through the years by the United States, This risk is non-negligible. There is another asset that is alternative to treasuries that are relatively more risk-free. That asset is physical gold. From January of 2023, physical gold is considered as Tier 1 asset under Basel III, upgraded from Tier 3. This shows that the Bank of International Settlements has a game plan for gold. We just don't know what it is yet. However, while physical gold may be without counterparty risk or risk-free, putting a risk-free rate that is competitive to treasury yields can be a bit problematic. Price of gold can be short-term volatile due to paper gold derivatives dominating COMEX in United States and LBMA in UK. This price manipulation in the US and UK may jeopardize the perception of gold as a stable asset class to be popularly used and accepted as risk-free rate. But if forces outside of the G7, perhaps with the assistance of Bank of International Settlements, can anchor risk-free rate to historical price movement of gold over an agreed period of time, that negates the volatility induced by paper derivatives that is dominating COMEX and London markets. So let's see how the battle of the risk-free narratives are going to roll out in the coming years. That's it for today. So if you guys find this video informative, please click like and do subscribe to my channel, and feel free to share to your network. And hope to see you around, and I'll be back soon for the next video and update. Bye bye.